Picture this. You walk into your bank tomorrow morning, march up to the teller, and confidently demand all your money in cash. Right now. Every penny. The teller smiles nervously, types something into their computer, then excuses themselves to fetch the manager. 5 minutes later, both of them return with that special look people get when they are about to deliver very bad news. They inform you as politely as possible that your money is not actually there. It never was. And if you keep asking uncomfortable questions, you might just discover that the entire financial system you have trusted your whole life is built on the most audacious magic trick in human history. How did we get to a world where money is simultaneously everywhere and nowhere? And why does the answer to that question matter more right now than it ever has before? If that thought already makes you a bit uncomfortable, this is exactly the kind of thing we break down on this channel. Take a second to subscribe so you do not sleepwalk through the next financial illusion the system throws at you. The story begins in a simpler time when your biggest financial worry was keeping your gold coins away from highway robbers. Back in the 17th century, before banking apps and credit scores, money had weight. Literally, if you wanted to store your wealth, you stuffed it under your mattress or buried it in your backyard like a paranoid pirate. But gold is heavy, shiny, and basically announces to every thief within 50 miles that you are worth robbing. So people did the sensible thing. They took their precious metals to the local goldsmith, who had mastered the ancient art of not getting robbed. These people had vaults, guards, and enough metalworking tools to make any would-be burglar think twice. You would hand over your life savings in exchange for a simple piece of paper. A receipt. Nothing fancy, just a note that said something like, "This paper represents Dave's gold, which is definitely sitting in my vault right now." The goldsmith's business model seemed straightforward enough. Charge people a small fee for storage, keep their gold safe, and everyone goes home happy. But then something interesting happened. People stopped coming back for their actual gold. Why would they? These paper receipts worked perfectly for buying things. Merchants accepted them, neighbors traded them, and suddenly everyone was using goldsmith receipts instead of the actual metal. This is where our goldsmith had what you might call an entrepreneurial moment. He looked at all that gold just sitting there, collecting dust, and realized he was sitting on the business opportunity of a lifetime. What if he wrote a few extra receipts? Receipts for gold that did not exist. He could loan out these phantom gold certificates to people who needed money and charge them interest. The customers got their loans, he got paid, and nobody was any the wiser. After all, who was going to check? It was brilliant, audacious, and completely insane. He was literally creating money out of nothing more than paper and trust. The goldsmith had stumbled onto something that would eventually become the foundation of every economy on Earth. He just did not know it yet. This was not some minor historical footnote. This was the moment when money stopped being a thing and became an idea. The goldsmith's customers believed their paper was worth gold, so it was. The entire system ran on collective faith, not physical reality. And as long as everyone kept believing, the magic trick worked. But governments looked at this chaotic system of private money creation and did not see danger. They saw opportunity. In 1694, the British government founded the Bank of England, and with it, they transformed the goldsmith's back alley hustle into official state policy. This was not just another bank. This was a money-printing machine with royal approval designed to fund the crown's endless military adventures across Europe. The government took the goldsmith's clever scam and gave it legal authority. They established something called a reserve requirement, which sounds responsible until you understand what it actually means. Banks only had to keep a small fraction of their deposits on hand. 10% was considered perfectly reasonable. The other 90% was fair game for loans. Here is how the mathematics of this works. You deposit $1,000 at the bank. They keep 100 in their vault and loan out 900 to your neighbor who wants to start a business. Your neighbor takes that 900 and deposits it in his bank account. Now his bank sees $900 in new deposits, keeps 90. and loans out $810. That money gets deposited somewhere else, and the cycle continues. Your original $1,000 has just created several $1,000s worth of new money in the economy. Money that did not exist 5 minutes ago. Money backed by nothing more than a promise that everyone involved can pay each other back. This is called the money multiplier effect, and it is the engine that drives a huge chunk of modern economic growth. It allows capital to flow to new businesses, investments, and innovations that would otherwise never happen. But it is also a system built on a simple fact. If everyone in this chain tried to withdraw their money at the same time, there would not be enough to go around. The Bank of England did not just legitimize this system. They made it the law of the land. Money was no longer a finite resource sitting in a vault. It became an expanding universe of credit and debt, limited only by people's willingness to borrow and their ability to believe. So what happens when that belief starts to crack? You get what bankers politely call a liquidity crisis, and everyone else calls a complete disaster. Once fractional reserve banking became standard practice, these panics became a regular feature of economic life. All it took was a rumor, a failed harvest, or news of war on the horizon. And suddenly people remembered that their bank only held a fraction of everyone's deposits. Picture this scene repeating itself throughout the 18th and 19th centuries. Normal people going about their normal lives suddenly transform into a desperate crowd, all rushing to the same bank at the same time, demanding their money back. The first few people in line walk away with their cash. Everyone else gets to stare at a locked door and a polite sign explaining that their life savings have vanished into a maze of bad loans and broken promises. This was not just a personal tragedy for the people involved. Bank runs created a domino effect that could bring down entire regional economies. When one bank failed, it often took several others with it. The psychological panic spread faster than any disease, turning rational people into a mob driven by the realization that their money was never really there to begin with. Before 1913, America had no central bank to act as a financial fire department. If your bank caught fire, it burned to the ground, taking your money with it. The system worked as long as everyone stayed calm and trusted each other. But the moment that trust wavered, it devoured itself. The entire fractional reserve system balanced on a knife edge of pure psychology. It was a collective illusion that required constant maintenance. And when that illusion broke, the mathematical reality underneath was absolutely brutal. After watching this cycle of boom and bust smash the economy every decade or so, the American government decided they needed something better than thoughts and prayers. In 1913, they created the Federal Reserve System, designed to be the ultimate financial fire department. The Fed's job was simple in theory. When banks started wobbling, flood them with emergency loans and restore confidence before panic went viral. Then they added another layer of protection in 1933 with the Federal Deposit Insurance Corporation. The FDIC was a masterpiece of psychology. The government made a direct promise to every depositor. Even if your bank makes the worst decisions in human history and explodes in a fireball of incompetence, we will guarantee your money up to a certain limit. This fundamentally changed the game. Why would you panic and run to the bank if the United States government had promised to cover your losses? It was like installing sprinklers in every room and giving everyone fireproof suits. The psychological trigger that caused bank runs was largely removed. But notice what did not change. They did not fix the underlying problem that your money is not actually there. They just made the promise that it would be there so convincing that you would never feel the need to check. The system became less about banks managing risk and more about a centralized authority promising to bail everyone out when things inevitably went wrong. It was a larger, more polished version of the goldsmith's original trick. And for a while, it seemed to work. Then came 1929, and reality delivered the ultimate stress test. The Federal Reserve had been created specifically to prevent the kind of catastrophic banking collapse that had plagued America for decades. When the stock market crashed in October 1929, this was supposed to be their moment to prove the system worked. Instead, they failed so badly that economists are still arguing about it today. Between 1930 and 1933, over 9,000 banks in the United States simply vanished. Not restructured, not gently merged, just gone. Nearly a third of all banks in the country disappeared, taking their customers' money with them. Imagine walking to your local bank and finding nothing but an empty building with a note taped to the door explaining that your life savings have been erased. The Federal Reserve, according to economists like Milton Friedman, made everything worse. Instead of pumping money into the system to stop the bleeding, they stood by while the money supply contracted by roughly a third. They had the fire hose in their hands, but spent their time debating proper technique while the entire economy burned. This was not just numbers on a chart. This was the complete destruction of people's futures. Retirement savings, business payrolls, college funds, all wiped out. The system designed to create prosperity from thin air had become incredibly efficient at creating poverty instead. The Great Depression proved that even a central bank could not stop a total collapse of faith when the panic was large enough and widespread enough. The psychological foundation that held the entire system together had cracked, and no amount of emergency lending could fully repair it in the short term. For most of history, even the most elaborate financial schemes had some connection to physical reality. The goldsmiths' receipts represented actual gold. Early Bank of England notes could theoretically be converted to precious metals. Even after the creation of the Federal Reserve, American dollars were tied to gold on the international stage through the Bretton Woods system established in 1944. This created a natural limit on money creation. Countries could not just print infinite currency because they needed enough gold reserves to back their promises. It was like having a leash on the money printing machine. By the late 1960s, though, America had been creating a lot of new money to fund the Vietnam War and large social programs. Other countries started getting nervous and began showing up with piles of dollars, politely asking for their gold back. The American gold reserves were draining away. So on August 15, 1971, President Richard Nixon went on television and did something that changed the global financial system forever. He announced that America would no longer convert dollars to gold. The leash was cut. The anchor was thrown overboard. In a single television address, the entire world moved to what economists call fiat currency. What does fiat mean? It is Latin for "let it be done," which in financial terms translates to, "this money has value because we say it does." No gold backing, no silver reserves, no physical assets of any kind. Just government decree backed by trust in the issuing authority, and in America's case, a very large military. Nixon's decision gave governments and central banks unprecedented power to create money without physical constraints. The goldsmith's trick had reached its final evolution. Paper receipts were no longer claims on gold. They were claims on nothing more than other paper receipts and the belief that other people would keep accepting them. Whether you view that as brilliant or reckless, the consequences are with us every day. Now that money had become a pure government construct with no golden anchor, someone had to decide how much of it should exist at any given moment. That responsibility fell to the high priests of finance at the world's central banks, armed with their most powerful tool, interest rates. The federal funds rate is the interest rate at which banks lend to each other overnight. By adjusting this single number, the Federal Reserve attempts to steer a multi-trillion-dollar economy. It is like trying to control the weather for an entire continent by turning one thermostat in a basement office. When the economy looks sluggish, they lower rates. This makes borrowing cheaper for everyone. Businesses take out loans to expand, people get mortgages and car loans, and newly created digital money flows through the system, hopefully stimulating growth. When the economy gets too hot and inflation starts rising, they raise rates. Borrowing becomes more expensive, money creation slows, and the economy cools down. This constant adjustment creates the boom and bust cycles that define modern economic life. The dot-com bubble of the late 90s and the housing bubble of the mid-2000s were both helped along by periods of very cheap money. The lesson is simple. Central planning has side effects. In theory, a small committee of experts can perfectly navigate between recession and inflation. In practice, they are always reacting to old data, and their interventions often create the very instability they are trying to prevent. They inflate huge bubbles by keeping money too cheap for too long, then have to burst those same bubbles by hiking rates to fight the inflation they helped create. It is a loop of controlled chaos, all rooted in the belief that they can fine-tune a system built on confidence. By the early 2000s, this system had been running hot for years. Fueled by low interest rates, banks began creating money on an unprecedented scale by writing mortgages to anyone with a pulse. They bundled these questionable loans into complex financial products called mortgage-backed securities and sold them to investors around the world. The fractional reserve system was running wild, building a global pyramid of debt on top of American real estate. Then in 2008, that foundation cracked. Homeowners started defaulting. The securities built on top of those loans were revealed to be toxic, and every major financial institution owned a lot of this bad paper. The trust that holds the entire system together evaporated almost overnight. Banks stopped lending to each other. Credit froze. This was a bank run on a global institutional scale, and the entire system came within hours of complete failure. But this time, there was a new rule: too big to fail. The government decided that institutions like AIG and several major banks were so interconnected that their collapse would bring everything down. So they launched the largest bailout in financial history. The promise originally made by the FDIC to individual depositors was now mirrored at the top of the system. The message was blunt. In the modern fractional reserve system, profits are private, losses are public. Banks keep the winnings when their bets work. But when those bets blow up, taxpayers are forced to absorb the damage to keep the game running. The system did not just survive 2008, it was effectively rewarded for failing. So what do you do after the worst financial crisis in decades, caused by too much easy debt, nearly destroys the world economy? If you are a central bank, you lower rates to zero and invent new ways to push money into the pipes. In the aftermath of 2008, the Federal Reserve began a radical monetary experiment. First, they dropped interest rates to zero. For more than a decade, the price of borrowing money was close to free at the institutional level. This was supposed to encourage lending and stimulate the economy, but it also inflated big bubbles in stocks, real estate, and pretty much every other asset class. Then they went further with quantitative easing. Here is how that works. The central bank creates billions of dollars digitally, then uses this new money to buy bonds and other securities directly from commercial banks. This pumps fresh reserves into the banking system, which banks can, in theory, lend out again and again. Between 2008 and the COVID-19 pandemic, the Fed's balance sheet ballooned from under $1 trillion to over $8 trillion. They were not just facilitating loans anymore. They were directly supporting asset prices and acting as buyer of last resort. This is the goldsmith's trick pushed to its logical extreme. We have moved from lending out deposits to lending out fiat currency to a central bank creating trillions of dollars from nothing to buy debt and keep the system from seizing up. The post-2008 world revealed something uncomfortable. Our economy had become addicted to this constant creation of cheap money. Any attempt to turn off the flow, raise interest rates, or shrink central bank balance sheets causes markets to panic. The system has become so fragile that it seems unable to function without a permanent drip of newly created currency. Which leads to the obvious question: what happens when the next serious crisis arrives? Put it all together and the picture is very clear. You take a goldsmith's clever side hustle, let governments scale it up, sever any connection to physical reality, and then hook the entire global economy on a never-ending stream of centrally managed digital credit. You get the world we are living in right now. The ultimate consequence of fractional reserve banking, especially in its modern fiat version, is inflation and debt. Every dollar created when a bank makes a loan slightly devalues every other dollar already in existence. Your savings, your wages, that emergency cash you keep for a rainy day, all lose a bit of purchasing power with each new loan the system creates. For decades, this process was slow and mostly hidden. But after the huge money creation after 2008 and the even larger response to the 2020 pandemic, the consequences finally showed up in the open as the highest inflation in roughly 40 years. At the same time, the system pushes everyone toward more debt. Governments fund spending by issuing bonds that are often bought by their own central banks. Corporations use cheap credit to buy back their own stock. Individuals lean on mortgages or auto loans and credit cards just to maintain a familiar lifestyle as their cash quietly loses value in real terms. The world is now saturated with debt at levels that would have shocked previous generations. Global debt compared to global output is at historic highs. There is no free lunch here. Creating money from nothing is not magic. It is a way of pulling future prosperity into the present, at the price of currency devaluation and heavier debt loads later. The system has enabled incredible growth and innovation. It has also created what you could call a treadmill economy, where everyone has to move faster simply to stand still. The goldsmith's sneaky side job has become the operating system of the planet, running on promises that get harder to keep with every new cycle of crisis and stimulus. We have built a global economy on the assumption that we can borrow our way forward indefinitely, and that confidence can replace underlying reality forever. Maybe that works. Maybe human ingenuity and technology will keep outrunning the math. Maybe central bankers really will manage to smooth out every crash and crisis with the right mix of interest rates and asset purchases. Or maybe we are sitting in the front row of the final act of the biggest financial magic show in history, and the audience is slowly realizing that the hat might be empty. Your bank account is essentially an IOU from a magician who is very good at promising. The real question is not whether the trick will eventually fail. The real question is what happens to your purchasing power while you wait to find out. If you want to keep decoding how this system really works and what it means for your future, subscribe and stay with this channel. The show is still going, and understanding the script might be the only edge you get in a game that was never designed for you to win.